I had the absolute pleasure of reading his book, The Seventh Property, Bitcoin, and the Monetary Revolution. When I say I couldn't put this book down, I mean, like back when Harry Potter first came out and I stayed up until 1 a.m. to know what happened, I was complaining to our producer, Chris, like I stayed up too late reading a book for the first time in God knows how long. Eric, thank you so much for coming and joining us on the show.
Dude, the Harry Potter comparison, that was a first. That means a lot to me. Thank you.
Dude, I mean, I'm a nerd. I just am. I've read tons of books about like what is money as my Bitcoin education and all of these different Bitcoin books. But I thought one thing that you did that I've never seen another book do, and if there are other books that do this, like I would love to dive into. But the first half of your book, instead of the traditional, like what is money? What is the history of money? You do that. But you also spend a lot more time. What is the history of banking? What are the history and how were banks formed? And my dad and I have been having a lot of conversations over the dinner table about your book. So thank you for that. And I want to start the conversation there because it was practically kismet. I read the section about, going off the gold standard is actually a very common thing that has happened throughout the history of banks. We've seen it in England, we saw it in Italy and Venice, and we saw it in France as well. And we witnessed it here 50 years ago in this country. And it seems like it's almost like almost not necessarily guarantee, but when you get to that point where you're now on a purely fiat system, eventually inflation starts to kick in. And like, it's like a twitch from these governments to turn around, and their first response is, we're going to force prices to stay where they're at. We're going to decree that prices stay where they're at. I read that segment, and then yesterday CNN starts posting all that crap. Should the government control the price of food and gas? So I want to start our conversation there and kind of break it down for our viewers.
Yeah, absolutely. So I think that's definitely when I got into this space. One of the big differentiators that with my book too, I think a lot of the material that I saw is that, there weren't a lot of people talking about banking. And the resources that you have are either like very technical or, very technical, like academic papers, or, older Austrian works that are like these, bricks that, a lot of people in this industry might be reading, but very few other people are going to spend the time to read something like that. And then there's books like, The Creature of Jekyll Island is another one that's also a really big brick. And they spend a lot of time talking about things outside of just banking. But I realized really quickly is like, you either have like that world of this very laborious way of getting your head around some of this stuff. And it still was there wasn't anything I encountered that was still incredibly clear to me. Or you have this highly simplified, like Investopedia type resources that explain banking, and that doesn't really get you anywhere. So that was one of the big things that I wanted to focus on. And it was just to give people that understanding, because it's impossible to talk about money without talking about how banking evolved, because the two work the same. They're both dependent upon one another. And we can see today with how our monetary system exists, it is just practically a banking system, and money is just a function used within it. But money, in historical periods was much more independent of a lot of those functions. And I think that having that distinction and seeing how that evolution occurred is, it's incredibly important. And so, what I get into with the book is I start off and I just like, I make this point and I say like, look, if we go far enough back and we look at like primitive societies, well, money was actually largely decentralized in many different ways. So like, the production of money, storage of money, the way people verified money between one another, anybody could go create money. There would be some sort of commodity that, localized groups would share, and they would look into these things and whatever is most scarce to them within their regions. And people would store money on themselves. And, that's where things like treasure chests started coming from. And, people had hoards, or even before that, people would wear jewelry because it was much safer to keep money on you than to have it sitting somewhere in a hiding spot, or more practical at least. And So a lot of that decentralized nature you can see with each evolution of our monetary systems over time, it started to centralize in different ways. And when you get to the side of banking, I kind of start that discussion in 17th century England. And at the beginning of all of it, people were storing a lot of their money in places like monasteries or different government facilities, and there was this whole occurrence in England during the 17th century where Charles I was appropriating wealth out of some of the money that people were storing in these government facilities that they had. So when that started to occur, we started to see more of a private emergence of a banking system in England. People started to say, okay, well, I don't really trust having my money stored in like these monasteries that the government has access to or any sort of their buildings. I am going to put my money somewhere else. And that system that kind of just voluntarily emerged was these goldsmith bankers. And that they were the guys who were smithing a lot of the gold that was being used in monetary form back then. So they had these large storage vaults. It was a very practical way for people to start storing the money. So they became these de facto banks. And they started creating these receipts that they would use for people. Rather than having to move gold around, they would give you a receipt that says, we have your money stored in a vault within our facilities. And this receipt entitles you to redeem that. And then a lot of what happened with fractional reserve banking emerged out of that, where people started to realize, well, we don't, or the goldsmith bankers started to realize, that we don't have to keep all of that gold in here. I mean, it's a lot of it's just sitting here. What if we start lending some of that out? And then they started maintaining a fraction of their reserves and creating multiple claims on the same bar of gold. So there's a claim that you, the depositor, has on that gold. You want to get it out whenever you want. And then there was also a claim that these guys were giving out when they were lending it. And they'd give another person a receipt and they'd say, look, you're entitled to this. This receipt is being considered money within our economy, and you can pull that gold out whenever you want. And so it's interesting because there's a bit of debate around how people defined government's role in all of this and how the Bank of England ultimately emerged. And a lot of the details of that I kind of get into in the book, but I think that what's important is that we also saw the government borrowing from these goldsmith bankers, and the government ultimately ended up defaulting to these bankers. And the Bank of England was created for a variety of forms. It was created to finance a war with Napoleon, against Napoleon. And but it was also created to pay back these debts to the goldsmith bankers. And that's when like the very first form of fiat in our modern banking systems, which are kind of predicated upon England, that's when that first experience emerged. They created the Bank of England. They said, we're going to create this legal tender. We're going to print this paper and we're going to pay off our debts with it. And that was immediately rejected by the market. And they subsequently went back to a gold standard. People are like, why in the world would we trust you with paper money? We want gold. And then, back to your point, there's kind of this pattern that I go into that we see throughout history. I take a look at the Bank of England, I take a look at the Bank of France, I look at Sweden a bit, and then I get into the US in a bit more detailed. And you can kind of see how most of the time when we saw pure fiat currency being created, it was for some sort of need to finance an excessive government expenditure where they couldn't tax people to get that. And that was typically war, pretty much always. And they go to war, they create a form of fiat, they print it endlessly, they destroy the credibility of their monetary good when they get off the gold standard. And there's a lot of gold and wealth gets lost and flows out of the country during these periods of time. And we see, typically that results in there are runs on banks, there's hyperinflation, governments always responded with price controls. And then what you see time and time again is there was some sort of societal uprising and ultimately some sort of regime change that occurs. So it's either like things really totally crumble and a new government gets put in, or there's a very significant change to the government that happens after that. And so rounding this all out, back to your point, we're witnessing that happening in modern times again. We see a very similar pattern that's emerging in this fiat system, and this fiat system has been around for 50 years, and that's an average lifespan of a lot of modern fiat systems. And here come the price controls, and I was tweeting this like I think it was like a month ago or something when a lot of this talk started first popping up. But it's like, yeah, I mean, this is a pattern in history. It's to be expected. And we're kind of just witnessing this whole monetary revolution happen right in front of us right now.
Yeah, and you keep touching on something that I do want to dive into, which is the I don't want to say necessity, but that's the only word I can think of right now. But like the necessity of these banks being created throughout these iterations of history, it seems like they are almost always directly linked back to some sort of war going on. We saw it with this country when Lincoln was in the middle of the Civil War and they pushed through banking legislation. Then we saw it with Andrew Jackson and the craziness of that bank. We saw it with the Napoleonic Wars as well. So in an era now, I'm going to call it peace because for the first time in like modern history in America, at least, we're not in a formal war in theory.
Yeah.
In theory and on paper. So because we are not in this war state at this moment, like what do you see as a potential avenue to exit said fiat system? Could it be as simple as let's go back to having something back our currency, or would it be an uprising causing a complete demolition, demise of the system we have? And we will dive in, I think, a little bit more on the creation of the Fed in particular, but I want to start.
Yeah. This is, I feel like this is definitely like the most popular question I always get. And it's incredibly speculative. It's very hard to say, we're subject to a very different, regime today. We're subject to a different modern economy. So like when we draw on history, I think when you look at it like a bird's eye view, we can be like, yeah, eventually there's going to be some sort of regime change. And then what does that actually look like? I think that what we're witnessing is, so the idea is basically that every time we get to these hyperinflationary environments, I don't think that we're at like hyperinflation yet. And I think that we're seeing more of like a short-term pattern of it here. I think that the whole idea of like hyper Bitcoinization and all of that is probably a bit further down the line. But what you typically see in economies is for when a hyperinflationary environment occurs is there is a fixed asset that ultimately liability. So like background, like when I say liability, our money today is from an accounting standpoint, a liability. It's debt. It's all backed by debt. And you kind of got to get into the details of the banking system to like understand that. But when we create debt, when the government issues treasuries, when banks issue different forms of debt, that is an expansion of the money supply. So our money has been tied to credit directly. And you can see that in like charts. If you were to look at like government debt expansion, you can see like, monetary expansion is commensurate with that. And that's how money works today. So like whenever we create this liability, and we've effectively created a system where that liability doesn't have to be paid back into any sort of fixed asset, which is formally on like the gold standard, that's what it would be. But because we don't have that anymore, the idea is like, well, where does the hyperinflation come? And that's why we're all here, is because we believe that there's an emergent private monetary good that people are voluntarily opting into, that I believe at some point in the not so distant future, it's going to have to be paid back into. So how does that happen? And I talk about this a lot in the book, but the adoption of Bitcoin is the key question. And once it reaches a certain critical mass of scale is when it's going to get that medium of exchange status. And it's going to be something that a lot of people are ultimately settling their, any sort of transactions in. So the economies that are furthest removed from our financial system are the first to go. And, it was interesting. I published my book in June, and then it was, I think 4 weeks later was when the El Salvador news popped up. And it's just a perfect case study. And it's exactly what we're looking at. We started, we saw the Rio de Janeiro news pop up with the mayor, and Panama is considering it. There's talks about a variety of other South American and even like African economies that are looking into these things. And it's all of these economies that are very far removed from our financial system that benefit the most from adopting an alternative to our current financial system. So, and that all ties into having an understanding of how the US dollar exists as a global reserve and the amount of power that we get in our economy from being a global reserve. And it's not all just the US wins and they don't lose. They do lose. It's just a question of who in the US loses. And there's effectively what happens is that when the US became the global reserve, and I make an argument for my book that at any given point in time, there's this trade-off that the people who control our monetary policy are considering. And domestically, we're looking at this trade-off between, okay, if we lower interest rates enough and we provide expansionary policy, how is that going to be expanding our economy? And our trade-off domestically is, well, we have too high of inflation. But there's another key piece that they're also being effectively limited by, and that's similar to inflation, tied to inflation. But the idea is if we do that and we depreciate the value of our currency enough, then we are slowly eroding the idea that we should be a global monetary reserve. And the reason is that 80% of foreign transactions are denominated in US dollars, and US dollars exist as about 60% of global reserves. So with all of that existing out there, any sort of devaluation of the dollar affects a lot of these broader economies as well. And a lot of these economies are competing for US dollars because of how contracts are denominated. And, that kind of goes back into the petrodollar system. But so when you have this competition, this means that the US gets to print money. We get to create something. Well, we get to create nothing. We don't create any sort of good or service that people value. And we get to trade that with foreign economies for things that have products and services that do have value. So we get to trade nothing for something. And that's a very powerful position to be in. And that's the primary advantage of being a global reserve in the US dollar. But the trade-off that we have to deal with is, it comes in a variety of different ways. But like one good example is like the labor-intensive economies, the countries with very large populations, like China and India. All of our labor is pretty much outsourced to them. Not all, but a lot of our labor is pretty much outsourced to them. And they are exporting that labor. And when they're competing against one another for US dollars, they can get more dollars if their labor prices are cheaper because it makes them more competitive. So we see this like global artificial suppression of a lot of wage labor in these foreign economies, which is why all of our domestic companies are outsourcing labor to them, because we're like, okay, well, we can get a lot cheaper labor abroad. Might as well do that. So what happens? Well, companies get cheaper labor, and that makes them more profitable. And the blue collar class and the middle class of the US get screwed because they have a hard time finding jobs in these different areas. And they don't have the skill sets to be competing in other areas of our economy, because we've just in a very short amount of time kind of like obstructed this whole area of our labor class that people had, until recent history always anticipated wouldn't be going away very rapidly. And it has, and they haven't had time to invest in new skills that are demanded domestically. So, that's one of the key issues. And when you see that amount of power that we have as a global reserve and how that impacts negatively some of these foreign economies, it's like, do they want to be competing over dollars? Not really, but that's just the way the system's been set up, and they have to play into it. And when you consider when Bitcoin steps in, it's like, well, I'm an economy. I'm operating on the dollar. They're devaluing it. I have an alternative system that I could be opting into that would increase wealth for our economy. It would attract investment. It's going to be stable, but stable in the long term. But the trade-off is they're effectively tying themselves back to this whole like gold standard idea, which compared to being bullied by the US economically is a good trade-off to make right now. And the question in the long term is like, okay, so we start to see a lot of these economies that have had a history of devaluing their, sovereign currencies. They're going to adopt Bitcoin as a reserve. They're going to gain capital. Once they can attract enough capital into their economy, are they going to start issuing their own forms of not pure fiat money, but money that's backed by Bitcoin? And are they going to take advantage of that system and keep lowering their reserves like we saw in history? And I think that there's a high likelihood that that will happen in a lot of different economies. But you will never be able to print more Bitcoin. So capital will ultimately start flowing into economies that have the that are most considerate of that trade-off and that are not trying to devalue the wealth of their citizens through some sort of sovereign regime. So it's going to take a lot of power away from governments in the situation because they're going to be held to a standard again. And the reason that they're going to be forcibly held to that standard as opposed to gold is that Bitcoin is digital and gold is physical. So we can move Bitcoin wherever we want permissionlessly. So people can always opt into Bitcoin and say, screw this, whatever government system that's been set up to make things more practical for us. We're going to be opting into this now. And that is a key piece of the game theory that I think is going to have that, gradually then suddenly effect and keep a lot of these, our public leaders who should be public servants more in the category of servants in the future. So to round that all out, I see some sort of system emerging with that group of incentives, and ultimately, how long that's going to take it's hard to say. Like we have a very the situation that with the petrodollar is very entrenched, and that will take a long time to be uplifted. And but I think that the pure incentive that having a good monetary system is going to attract capital to economies, is going to get us to scale pretty rapidly on the Bitcoin network. And as we have more utility and more financial services and products develop in this ecosystem so that larger, bigger actors and, very serious capital allocators within the world can seriously operate independently within the system. Once we get to that level, then I think is when things start to get very, very rapid. So I don't know, it's about as detailed as I can really get. But it's a huge question and nobody knows the answer to it. And
no, of course it's purely speculative. And I appreciate you tackling that. I do want to unpack a couple of the things that you brought up. Firstly, Alex and I were just talking about this before we had you on about, who stands to lose the most by going over to a Bitcoin standard. And it's those closest to the monetary system. Like you mentioned, I was already a fan of your writing and the book before I got to this, but my parents are Iranian immigrants. And then you're highlighting the fact that Iran is the perfect example of a country that, dude, you leave America and you go watch the news outside of America, the global powers of the world are the US, China, Russia, Iran. It's only just in the US and US news that doesn't portray Iran as such. And because Iran has been on the outskirts of our fiat system for so long, I bang that drum of please let us go down that path. They have such bad inflation at this moment. Last I checked, it was already over 30%. But again, we don't talk about Iran in this country, so we don't even see, feel, or know about that type of stuff going on.
Right.
Secondly, you also kind of brought up in the book specifically, the raising of interest rates and sort of the dichotomy of, does this help us being the US if we do this, or does it help sort of the international people who rely on our monetary system as their backing? And this balancing act was what led to, I don't think you, correct me if I'm wrong, I don't think you actually suggested this in the book. I personally just kind of concluded this, but there's definitely some sort of malicious intent at a certain point in the 20s and 30s when the US quickly realized the British pound is on its last legs, and there is a way for us to almost supersede them if this is done methodically and carefully. It's never suggested in your book, but frankly, I love to believe stuff like that, because I do think that when you have 6 of the most powerful people meet not even 30 years ago to design and implement a new financial system for the world, and then a new opportunity arises within a lifetime for them to now turn around and say, oh, this financial system that we've developed in-house can become the global financial system if we just sort of pull on this one thread at the right pace at the right time. Everyone has to come to us. And then we bore witness to that with Bretton Woods, and then whatever decisions Nixon thought were right or wrong led to where we are today.
Yep. It's interesting. So it kind of goes back to my point around the trade-off between domestic and international interests that as a central bank that you have to face. And that's that, and it's called the Triffin Dilemma. But the idea is that, so if you are a central bank and you decrease interest rates, that, that increases lending in the economy, and that's expansionary to your economic activity. But it's bad for you internationally because gold starts to leave the country. And what that means is that there's a lot of capital allocators when they're considering what they're going to do or where they're going to borrow. Well, you want to borrow from a place that has the lowest interest rates. So if you are an economy and you're lowering your interest rates, then people are going to borrow from you much more frequently. And then they take that, what they're borrowing, and they invest that capital somewhere else where they're going to get a higher interest rate for it. And that applies to gold, and particularly in this situation during this period of like the 20s and 30s, is gold starts to leave the country because people start to actually borrow that physical gold, and then they take it and they would invest it into economies with a higher interest rate. So that devalues your economy, and you start to have a gold shortage, and your idea of, this concept of who's the dominant monetary authority, who has the strongest currency, starts to depreciate. And then the alternative is true if you increase interest rates. If you increase, it's bad for you domestically because you start to contract all this credit that you've created, and then your economic activity starts to slow. But it's good because gold starts to come back into your country. You're a higher interest rate country. People want to invest more, and that benefits you as well in terms of your monetary dominance. So I think when you look at the Great Depression, the consensus among economists is that the Great Depression was somewhat of a phenomenon, and it's not totally like explainable. But a big thing that we know that was bad is the gold standard, because if we didn't have a gold standard, then we wouldn't have to deal with this trade-off. And that's just I think that just really retards the whole idea of what the purpose of a standard is. The purpose is, like, you can get rid of, and I make this point in the book, but like, you can get rid of your diet, and you may not break your diet if you don't have a diet, but you'll still get fat. And that's the whole point, is that, you're still going to get fat. And like what we're seeing right now is that we've gotten very fat. And I think that, when we go back to the periods of the 20 through 30s, we had this huge run up in the economy through our monetary policy, and it was highly expansionary in the roaring 20s. And then we got to a point after the war when Europe, or England, was in a very poor economic situation, and they were losing international monetary dominance. And I think that a primary incentive for them to raise their interest rates, or for the US to raise interest rates, was that it would attract more gold, and it would effectively eclipse the monetary dominance of England back then. And I do agree with that. I think that there was a major incentive for that. These are complicated questions. There's quite a bit that is going on that's affecting a lot of these decisions. But from my perspective and from what I've read, I think that was probably a primary motivator for us raising interest rates. One of the most interesting things that I read, and a key thing about my book too, is a lot of people are skeptical of this narrative just because it's an emergent narrative, it's new. And of course, everybody will, like, at least if you get into the economics worlds of the academics, they're going to call it tinfoil hat type thinking. So I wanted
that is always
to
welcome on this show.
Yeah. But it's like, when I was writing this book, I was like, okay, well, I want to make sure that I try to create the most, I believe in a lot of this narrative, and I don't believe, I wanted to present the facts of history that existed, the story that I wasn't told when I, got an undergraduate degree in finance and economics. And it's still crazy to me to this day how all of this stuff is overlooked when you go get education in undergrad. And but I wanted to present that side of the story, because that is the side of the story that other people aren't getting. But I wanted to do that from the perspective of using sources that aren't biased necessarily towards that type of thinking. So I sourced a lot of my information just directly from the Federal Reserve. And there's a lot of these like Federal Registrar papers that they'd have over the years. And I found a couple great ones. There's this guy, like, his name was Leland Krabbe. And he had a great history and this was, one of I can't remember which Federal Reserve Bank he was at, but this was, one of the guys who was running one of the Federal Reserve banks back in the 80s. And he goes through this history. And one of the most interesting observations that he called out was, so hold on, it was Yeah. So I might be wrong on these numbers, but they're in my book. They're right in my book. But so there's a legal mandated reserve ratio that we had at that time of gold to
Mhm.
US dollars that we need to have. And that was 35%. And before FDR was confiscating citizens from gold from citizens back then, and before we did this interest rate hike, it was at 51%. So we were well above like this mandated reserve ratio that we needed. And the fact that we ended up raising interest rates despite not even being close to breaking our mandated ratio on gold reserves, I think that that's very telling of what their incentives were. It wasn't about maintaining our reserve ratios. It was about trying to eclipse England in monetary dominance and being far superior to them.
Totally.
So I think that so I definitely think that there's a lot of motivations for why we would implement monetary policy historically as well as today that aren't really talked about in the primary media, but are kind of the primary motivators of why the Fed makes certain decisions.
Absolutely. And we have a little bit more than 5 minutes, and I want to actually, I promised Eastside Tony that at some point this would kind of get brought up. And I think if I remember the numbers correctly, we went from 51% when FDR started enacting that policy to then I believe it got up to 65%. But on the other side of that, if we do go to a point where there is not enough gold in the reserves in these type of systems, then all of a sudden everyone all at once is going in to redeem this ticket, if you will, saying like, I'm entitled to a certain amount of gold. You brought up something, and again, I think this goes to how strong of a writer you are and how well written this is, where you essentially lead us to a point where you say without saying, like, this system of fractional reserve currency in particular is in essence a Ponzi scheme, because the last person who's holding their ticket with no redeemable gold just lost everything they have. And you're essentially left, there's no one's going to come bail you out because there's no more gold left. The fiat system is completely shattered because everyone went to go redeem what backed that fiat currency. And then all you're left with is worthless paper money, i.e. the Weimar Republic.
Yep. Yeah. And one thing that I think is important to talk about on that is that it's not that the whole idea of fractional reserve banking is inherently bad. I just talk about all the bad things because it's accepted as a form of monetary creation and one of the only ways to do it nowadays. But so I'm giving the other side of my book. But to round that all out, it's not that fractional reserve banking is inherently bad. It's the moral hazard that results from a system that rewards assuming risk in a fractional reserve system, which i.e. bailouts. And when we can do bailouts, then and we are able to print currency and redistribute wealth to people who have assumed too much risk and have caused failing enterprises to happen. That's the moral hazard that we need to remove from the system. But in a future, I see a future where we do have gold or Bitcoin as a reserve, and we do have paper receipts that are being traded, or paper is, I'm using it more figuratively, but some form of money that derives its value from Bitcoin as a reserve, being traded around the globe. And there's going to be private institutions that I think are going to be issuing all of that, and they're going to live and die by their reputations. And as long as you can't get bailed out and there's nowhere for them to run and hide, and that when they fail, that will create, I think, a very efficient system that will work well for people. And that'll probably be existing in, concurrently with, and they'll be utilizing things like the Lightning Network and stuff like that. I just think that a lot of people are like hyper against this whole idea of credit and fractional reserve when it does serve a primary function in our economy. How money can bring value forward in time. Credit allows us to bring it from forward in time back to the present. So it's just an alternative function that needs to exist in some form, but it's probably going to be significantly less. And it's going to be used in a manner that I think is sustainable, in which people live and die by their reputations. And
No, absolutely. I think we've talked on this show ad nauseum about how against bailouts in general we are, regardless of what they do, or what industry, who they help. I'm a firm believer that bailouts are, in essence, a form of corruption and incentivizes these centralized powers to help those that align with them instead of the public and helping the public good. Another thing that I think gets touched on in your book is you talk about how centralization is an inherent flaw in all of these previous financial systems, but there's another layer to that, I think, which was touched on in the Andrew Jackson incident, where it was the greed itself that really pushed forward the fraudulent activities, the fraudulent behaviors, and in turn led to the demise of that bank, rightfully so. But it really seemed as though it was greed that was motivating that banker. I'm blanking on that one banker's name.
Oh, Nicholas Biddle.
Thank you. Yes.
Yeah.
And it felt like you could almost apply that logic to a lot of iterations in the past, where it was greed that motivated certain groups to like continue to push the bounds of how far can we take this money until finally the money collapsed. Do you think there is a balancing act that, at least for right now, with centralized fiat systems, those who have sort of their foot on the gas, if you will, have a duty to not be overly greedy? And this is going to have to be our last question, unfortunately. But
yeah, and I'm glad that we're ending on this one. So I think that this is something that I think is going to probably cause a big divide within the Bitcoin community over time. There are people that fundamentally believe that there is a moral imperative that needs to be maintained, and that greed is something to be avoided. I think that I take the other side on that. I operate my life around the assumption that everybody is inherently greedy, that society functions on individuals pursuing their self-interest, and that we need to understand that and build systems that reward good behavior, but knowing that people act that way. So when I think about like greed, it's just like, sure, like Nicholas Biddle, probably more greedier than the average guy, probably pretty power hungry, but it's amazing how a lot of people who maintain a narrative that they're good people can become bad people once they actually do get power and once they actually do get rewarded in certain ways. So it's not that I do think he was greedy, and I do think that was a problem. But I think that if you were to have taken Andrew Jackson and, turn the tables and put him in his shoes, that, who knows what Jackson would have done either. I like to believe Jackson was a pretty good guy though. So, but nonetheless, I think that it's really important to consider that the greed is bad, but we need to operate on the assumption that everybody is that way, and build systems and ideas and not assume that people aren't that way. Because it's when we start assuming people aren't that way is when problems emerge, because that's typically, I don't think, the right assumption. Yeah.
For sure. Well, Eric, this has been such a fun conversation. I'm sorry that we're ending it now. We'll have to find a time to bring you back and continue this conversation. But in the meantime, be sure to check out Eric's book, The Seventh Principle of Bitcoin. And we'll post a link in the chat as well and in the show notes so that you guys can go ahead and check it out. I highly recommend. It was an absolute pleasure reading it and chatting with you, Eric. Thank you for joining us.
Likewise, man. Thanks for having me on. It was a blast.